The silence before the storm. It is Sunday evening, January 18th, 2026, and I need to tell you something most people will not realize until it is far too late. I am a private commodities analyst. I have tracked physical silver markets for 12 years. If you want to know who is behind this AI avatar, there is a channel intro on the homepage. But right now, we do not have time for backstories. Right now, while the world watches football and scrolls through phones, the global financial plumbing for silver is hitting a literal brick wall. The mainstream financial media spent Friday afternoon talking about a Greenland real estate deal. They framed it as geopolitics. They called it diplomacy. They used words like negotiating tactic and trade leverage. The screen shows you a narrative, not reality. This is not about land. It is not about Arctic minerals or strategic positioning or any surface-level analysis you will read in the Wall Street Journal tomorrow. This is about a physical liquidity trap that is about to strangle the London Bullion Market Association, and by extension, the entire global silver pricing mechanism. Here's what actually happened. On Friday night, the administration dropped what I am calling the nuclear tariff bomb. 10% tariffs on imports from 8 European Union nations, plus the United Kingdom, effective February 1st. That is 14 days from now. And here is the part that should make your hair stand up. That list includes the UK, home of the LBMA, the single most important silver trading hub on Earth outside of New York. By the time the opening bell rings tomorrow night, the economic pathway for silver to move across the Atlantic will not just be expensive, it will be economically impossible for bullion banks to maintain standard procedures. But that is not even the worst part. Let me be very clear about my claim because this is not speculative, this is math. Trump's 10% tariff, which escalates to 25% if no Greenland deal is reached by June 1st, has created what I call a one-way valve in the global silver market. It has effectively trapped millions of ounces of physical silver within United States borders, leaving London markets to starve on existing inventory. And here's the stake. If the LBMA cannot borrow metal from COMEX vaults in New York to cover short positions, the global pricing mechanism breaks down completely. We are not talking about a price squeeze taking silver from $90 to $110. We are talking about a fundamental fracture in how this metal is valued globally. We are looking at a scenario where physical silver could legitimately trade above $100 per ounce, not from investment demand, but from a structural impossibility in the supply chain. I will walk you through 3 things. First, I will explain exactly how this geographic arbitrage trap works and why it matters more than any other factor right now. Second, we will run the actual stress test math on what happens when that 10% becomes 25%. Third, I will share my personal battle plan for the Monday Open in the next 14 days, because when the music stops, you want to already be sitting down. Before we go further, you need to understand something. Gold is the money of kings. Central banks hold it, governments hoard it. It is the anchor of the monetary system. But silver is the Achilles heel of the entire banking system, and that heel is about to get shot with an arrow. Let me give you the hard data. As of this afternoon, around 2:30 p.m. Eastern, silver was trading at $89.94, down 1.62% from Friday's close. But here is what the paper market does not understand yet. The physical reality underneath those ticker symbols. While paper prices dipped slightly Friday, the bid-ask spreads started widening. Not dramatically, not in a way that would trigger CNBC alerts, but if you watch actual physical dealers, you saw it. The spread between what someone will pay and what someone will sell started stretching. And the Friday night surprise, the actual tariff announcement, happened after the LBMA had already closed for the weekend. London does not even know they're in a trap yet. Let me give you context that makes this even more insane. In Q1 2025, we watched dozens of millions of ounces of physical silver flee London vaults and land in New York. The bullion banks thought they were being smart. They were front-running the Section 232 review everyone knew was coming. Section 232 is the mechanism the administration uses to determine if imports threaten national security. Silver, as a strategic mineral used in everything from solar panels to missiles, was obviously on that list. So the banks did what banks do. They moved their metal ahead of potential restrictions. They repositioned physical inventory from the LBMA into COMEX warehouses, thinking they would be safe from supply chain disruptions. Now, with one announcement, with one weekend tweet, the door has been locked from the outside, and the metal is trapped in New York. And the banks just lost their ability to play whack-a-mole with physical shortages across the Atlantic. Let me teach you a concept most retail investors have never heard of, but institutional traders live and die by: the geographic arbitrage trap. Here's the simple definition. This occurs when the cost to move an asset between 2 global exchanges becomes higher than the price difference between those exchanges. When that happens, the flow of supply completely paralyzes. Let me give you an analogy. Imagine you have 2 wallets. Your left pocket London is completely empty and you have a bill due immediately. Your right pocket, New York, is stuffed full of $100 bills. Normally, you just move cash from your right pocket to your left and solve the problem. But here's the catch. Every time you move a $100 bill, the government intercepts it and takes $25 as a tax. You are technically rich in one pocket and functionally bankrupt in the other, and you cannot fix the problem without losing 25% of your wealth. That is a geographic arbitrage trap. Now, apply this to silver markets today. The United Kingdom, specifically the LBMA, is critically short of physical silver. They have obligations, contracts, delivery demands from funds and industrial users who need actual metal, not paper promises. Under normal circumstances, this would not be a problem. When London gets short, they just arrange a shipment from New York. Metal moves across the Atlantic every week. It is part of the global flow that keeps prices synchronized. The mechanism works like this. If silver trades at $99 in New York and $91 in London, arbitrage traders buy in New York, ship to London, sell for a $1 profit, and pocket the difference after shipping costs. That constant flow from low price to high price zones keeps global markets balanced. But with a 10% tariff, and eventually 25%, that metal can never economically return to the United States without banks taking a massive loss. Think about what that means. If you are a bullion bank and you ship 1 million ounces from New York to London to cover a short position, you have just made that metal 25% more expensive to ever bring back. The result is that two separate prices for silver are about to emerge. I call them the trapped US price and the starving London price. And when those two prices decouple, when the arbitrage mechanism breaks down completely, we will witness something that has not happened in modern precious metals markets. Let me walk you through the actual math, because this is where theory becomes reality. Scenario A, the 10% friction. At $90 per ounce, a 10% tariff adds $9 to the cost of every ounce imported into the United States. Practically, it means if silver trades at $90 in New York and $95 in London, it is still not profitable to ship metal from London to New York, because you would pay $9 in tariffs and lose $4 on the trade. This immediately creates a floor for US physical metal. Domestic silver cannot fall below the London price minus the tariff cost, or arbitrage would kick in. But here is where it gets dangerous. Scenario B, the 25% nuclear option. If no Greenland deal is reached by June, first, and I think the odds are lower than the media suggests, the cost to bring silver back into the United States jumps by $22.50 per ounce at current prices. Let me say that again, $20.50 per ounce. The LBMA is rumored to be critically short. I do not have exact figures because banks do not publish short positions in real time, but based on inventory drawdowns we saw in Q1 2025, we are talking potential exposure of 50 million ounces or more. If they need 50 million ounces to satisfy delivery obligations, and the United States is the only source, the premium required to move the metal must exceed the 25% tariff. Here's the calculation that should terrify anyone short silver right now. Current price, $89.94. Add 25%, that is $112.42. That is the mathematical break-even point for global silver flow under the 25% tariff scenario. $112.42 is not a speculative price target. It is not a hopeful projection from a gold bug. It is the minimum price required for arbitrage to function under the new tariff structure. I'm not talking about leverage, futures, or options. I'm talking about physical metal I can hold. Trigger number 4, margin hikes above 20%. If COMEX hikes margins by more than 20% in a single day, I sit on my hands. I do not play the paper game at that point. Margin hikes signal the exchange is trying to suppress price by forcing speculators out. When they are that aggressive, it usually means the physical situation is worse than they are letting on. At that point, I let the physical metal do the work. I do not try to trade around it. Trigger number 5, the London-New York spread. This is the nuclear option indicator. If the spread between London spot prices and New York spot prices hits 5% or more, I prepare for a force majeure event. Force majeure is the legal term for we can AT deliver because of circumstances beyond our control. It is the escape hatch exchanges use when they cannot meet obligations. If that spread hits 5%, it means arbitrage has completely broken down. It means the one-way valve is fully closed. It means we are in uncharted territory. At that point, my personal plan is simple. Hold physical, avoid paper, and wait for dust to settle. Let me pull back the curtain on something not talked about enough. Bullion banks are not afraid of high silver prices. They have seen silver at $49 in 2011. They have navigated higher gold prices. They can hedge and adjust their books. What they fear is a market where they cannot move metal to where they need it. The entire fractional reserve system in precious metals depends on geographic flexibility. When London gets tight, metal flows from New York. When New York gets tight, Metal flows from Zurich, Singapore, or Hong Kong. It is a global shell game, and it only works as long as the shells move freely. The moment you lock down one major shell, the whole illusion falls apart. That is exactly what this tariff has done. It has locked down the New York shell. The LBMA cannot borrow from COMEX anymore, not at prices that make economic sense, not without taking catastrophic losses on the round trip. So, what do? They have three options, all bad. Option 1. Let physical silver in London spike to $100 or more to incentivize existing holders to sell. Option 2. Change rules and allow cash settlement, destroying confidence in the entire LBMA system. Option 3. Declare force majeure and admit they cannot meet delivery obligations. Pick your poison. Every option is catastrophic for the paper silver market, and every option is bullish for anyone holding physical metal. Here is a piece of context making this even more absurd. In Q1 2025, we saw a massive movement of silver from London to New York. I mentioned it earlier, but I want to dive deeper. Banks knew a Section 232 review was coming. They knew silver would be classified as a strategic mineral. They knew import restrictions were possible. So what did? They moved their metal ahead of time. Dozens of millions of ounces flowed out of LBMA vaults into COMEX warehouses in New York. It was the largest quarterly movement between those two markets in recent history. The beautiful irony is they thought they were being smart. They thought they were front-running restrictions. They thought they were positioning themselves on the right side of the trade when tariffs hit. But they made one critical miscalculation. They assumed tariffs would restrict imports into the United States, not exports out of the United States. They moved metal into the U.S. to protect it from import tariffs. Now they realize it is the export side that is trapped. It is like a bank robber who breaks into a vault, stuffs his bag with cash, and then realizes the only door out is locked from the outside. They are stuck. And they did it to themselves. I have been through many silver rallies. I was around for the 2011 spike. I have watched countless to-the-moon predictions fizzle. Many in the silver community have developed cynicism about squeeze narratives. We have heard it all before. This is it. The banks are finally going down. Then nothing happens. Price rallies for a week. Banks slam it back down, and we are back where we started. Let me tell you why this time is structurally different. Every previous squeeze attempt has been demand-driven. It has been about investment demand overwhelming supply. It has been about retail buyers or hedge funds piling in, trying to corner physical metal. And every single time, banks have had the same response. Short more paper, lease metal from central banks, move physical inventory from other global vaults to wherever pressure builds. They have always had geographic flexibility as their release valve. This time, that release valve is gone. This is not about demand. This is about supply chain paralysis. This is about a policy decision creating a structural barrier to normal metal flow. You cannot short your way out of a tariff. You cannot lease metal from a central bank if that metal cannot economically cross the Atlantic. Normal tools banks use to suppress price do not work when the fundamental problem is logistics. That is why this week could be the catalyst that finally breaks the paper market. Let us talk about the elephant in the room. This entire tariff structure is theoretically contingent on Greenland negotiations. The administration has made it clear, make a deal on Greenland and tariffs go away. Fail to make a deal, and the 10% becomes 25% by June 1st. So, what are the odds of a deal? I have been reading everything on the Danish government's position, Greenland's political situation, the broader geopolitical context. Here is my personal assessment. Odds of a comprehensive deal by June 1st are below 30%. Here is why. Greenland is not just real estate. It is a sovereignty issue for Denmark, a cultural issue for Greenlanders, and a strategic issue for the entire European Union. If the US gains control of Greenland, it fundamentally shifts the balance of power in the Arctic. This is not like buying an office building. You cannot just write a big enough check and close. There are political constituencies in Denmark that would rather see their government fall than sell Greenland. There are Greenlanders who view any sale as a betrayal of autonomy. Critically, there is no urgency on the European side. From their perspective, they can wait out tariffs, absorb economic pain, hope for a change in US policy after the next election. They are playing a long game. The administration is playing a short game, meaning odds of a breakdown in talks are significantly higher than the market is pricing. Every day without progress is another day closer to the 10% tariff becoming reality. I want to address something driving me crazy about how most analyze precious metals. They look at price charts, technical indicators, trend lines, Fibonacci retracements. They try to predict the next move based on patterns. That is fine for normal markets. It works for stocks, Forex, even gold most of the time. But silver is not a normal market. Silver has a physical supply constraint that does not show on any chart. You cannot see a geographic arbitrage trap in a candlestick pattern. You cannot draw a trend line predicting force majeure. The price on your screen is a derivative of a derivative of a derivative. It is a futures contract based on a spot price based on a flow of metal that may or may not exist in quantities the market assumes. When that underlying flow breaks down, the chart gives no warning. The chart shows 89.94. It shows a 1.62% decline from Friday's close. It looks calm. But underneath, the physical market is seizing up. Dealers widen spreads, refineries are backlogged, industrial users panic buy because they know what is coming. None of that shows on the chart until it is too late. By the time the chart reflects physical reality, the move has already happened. You're not getting in at $90, you are chasing at 110. That is why I focus on physical inventory data, spreads, delivery patterns, the leading indicators that actually matter. The chart is the lagging indicator. It tells where we have been, not where we are going. Let me paint a picture of the next 3 months if this tariff holds. By early February, we start seeing a persistent premium for physical silver in London relative to New York. It starts small, maybe 2-3%. Mainstream media will call it a temporary dislocation or regional supply constraints. By March, that premium widens to 5 to 6%. Dealers in London charge $100 per ounce, while New York trades at $95. Arbitrage traders look and say, why not ship from New York to London and capture that $5 spread? Then they remember the tariff. They remember shipping an ounce to London means paying a $9 or $20 tariff to bring it back. They realize arbitrage does not work. By May, if no Greenland deal, we see a 10-15% spread. London silver at $120, New York at $105. At that point, the LBMA has a choice. Keep allowing physical delivery at elevated prices or implement cash settlement. If they choose cash settlement, confidence evaporates. Every holder of a London silver contract realizes their contract is not backed by actual metal. It is a paper promise settled in fiat currency at the exchange's discretion. If that happens, flight to physical accelerates. Everyone who thought they owned silver through an ETF or vault storage realizes they own a claim, not actual silver. The premium for metal you can hold goes vertical. This is the two-price world we are entering. Paper silver at one price, physical at another, with a widening chasm between. Here is something not getting enough attention. Industrial demand for silver is not optional. It is not like investment demand where someone can decide to wait for a better price. If you are a solar panel manufacturer, you need silver. If you make semiconductors, you need silver. If you produce medical devices, EV components, or military hardware, you need silver, and you need it on a schedule. You cannot tell your production line, sorry, we pause for 3 months while we wait for silver prices to come down. Your contracts have deadlines, your customers have orders, or your factory has overhead. So what happens when industrial buyers realize normal silver flow from COMEX has been disrupted by a 25% tariff? They panic buy. They lock in supply at any price. They build inventory buffers they normally would not carry because the cost of running out is higher than the cost of overpaying. That industrial bid, that non-price sensitive demand, pushes the market over the edge. Industrial buyers do not care if silver is $90 or $110. They care about securing supply. They care about keeping production lines running. Combine that industrial bid with a geographic arbitrage trap preventing normal supply flows, and you get a price spike that does not respond to normal market dynamics. Banks can short all the paper they want. It does not matter. Industrial buyers need physical metal and will pay whatever it takes. I am going to make a prediction that might sound counterintuitive. I do not think we see a crash this week. I do not think silver falls back to $70 or $60. Here's why. The market has not fully priced in the tariff trap yet. Most participants still assume this is a negotiating tactic resolved before February 1st. But smart money, institutional players who move physical metal, are not selling. They are holding, waiting to see which way this breaks. As long as physical holders are not selling, there is a floor under price. Could we see a dip to $85 on "it's just a bluff" headlines? Absolutely, I plan for that. But a full crash back to the 70s? I do not see it. There's too much physical demand, too much industrial buying, too much awareness among large holders that something structural is changing. Downside risk is limited. Upside risk is unlimited. That is a risk-reward profile I'm comfortable with. If you trade silver futures, use leverage, play the paper market for short-term gains, I want to say something directly to you. You are playing a game about to change rules mid-round. Normal patterns do not apply. Normal support and resistance levels do not matter. Normal correlations with the dollar, gold, or equities are breaking down. When trading a geographic arbitrage trap scenario, technical analysis is almost useless. You're not trading sentiment or momentum. You are trading logistics and policy. If you are short this trade, directly or through selling covered calls or any bearish strategy, you need to understand your risk is not symmetrical anymore. Downside might be $10. Upside might be $50. Margin calls do not care about your thesis. I'm not telling you to close positions. I'm not giving advice. I'm just saying what game you're playing. Understand the referee might change rules. Understand the floor could fall out or the ceiling blow off and your stop loss might not protect you. If that does not scare you, trade away. If it does scare you, there's no shame sitting this one out. We are now 14 days away from February 1st when the 10% tariff officially kicks in. 14 days for the LBMA to source metal, for banks to reposition, for Greenland negotiations to produce a deal or fall apart. 14 days for the market to wake up. I've done this for 12 years and never seen a setup quite like this. I have seen supply squeezes, price manipulation, regulatory changes, demand shocks, but I have never seen a single policy decision create an immediate structural barrier to the normal functioning of a global commodity market. This is not a prediction about silver going to $100 based on investment demand, inflation fears, or dollar devaluation. This is an observation that the plumbing is broken. The pipes allowing silver to flow from New York to London have been crimped by a 25% tariff. Nobody has figured out how to uncrimp them yet. And when plumbing is broken, pressure builds. It does not matter if anyone wants higher prices. It does not matter if banks try to suppress it. Physics does not care about your short position. Let me bring this home. It is Sunday evening, January 18th, 2026. Silver trades at 89.94. Markets are quiet. Mainstream media talks about Greenland, diplomacy, geopolitics. Underneath all that noise, a physical liquidity trap tightens around the LBMA. In 14 days, the cost to move silver across the Atlantic increases by 10%. In less than 5 months, that cost could be 25%. Banks moved millions of ounces into U.S. vaults, thinking they were front-running import restrictions. Instead, they trapped themselves. The LBMA is short, COMEX is the only source, and the door between them is closing. I hold my physical silver. I watch the triggers I outlined. I prepare for a market that could legitimately trade above $100, not from hype, but from math. You have been given information, you have seen numbers, you understand the mechanism. What you do is up to you, but do not say you were not warned when you wake up one morning and silver trades at 115. Every dealer is sold out, premiums are 30% over spot, and you wonder how you missed it. The signal was sent this weekend. The question is whether you will listen. If you want to understand how banks set this trap in Q1 2025, how they moved all that metal ahead of the Section 232 review, there is a deep dive linked in the description. But right now, focus on the next 14 days. The clock ticks, the valve closes, and when it fully shuts, we will find out exactly how much physical silver actually exists versus how much paper silver has been promised. I have a feeling the answer will surprise a lot of people. Stay sharp, watch the data, and trust the math.